All right. Good morning, good afternoon, good evening to you all listening. Off the cuff, here we go. What's happened? We had our game short squeeze. Did it squoze? Did it not? Not sure. But what we do know is that hedge funds got angry. Not only did they get angry, we also exposed some market inconsistency, some grayness in the equities market. We saw a lot of chatter around shorting, naked shorting, all of these new concepts to a lot of investors, and that became mainstay discussion for certainly the past few months. And we, the people, we had a bit of a win over the hedge funds. Pat on the back there, excellent. We're also looking at new regulations, implementing new regulations. I think there's a new ruling, the notice to amend the supplemental liquidity deposit requirements, SR and SEC 2021 801 802, where disclosure of these liquidity or leverage positions would have to be reported more frequently by the hedge funds. This is a massive, massive deal. So hedge funds, as we know, some are highly leveraged. Think about Kegos, what happened there. And they don't want to be caught out, right? Hedge funds like to operate with a sense of grayness, so that not everything is as transparent. So this ruling will make things more transparent, hence why everyone is rallying behind the ruling. So now the hedge funds have two problems the way I see it. One, retaliation is a must for what had happened with the GameStop, to some degree AMC and others short squeezes. They were made to look a fool, so that's always in the back of their minds. And second, they now have to deal with these regulatory requirements being implemented hopefully by the end of May or early June. So what do the hedge funds do? Now, a little bit of background on these hedge funds. They certainly work together, right? Now, it's a very, very cutthroat industry. Hedge funds themselves want to outdo other hedge funds. They want to attract new money. And of course, they want to outdo the indexes, the S&P, the Dow, the NASDAQ, and so on and so forth. That's the primary goal of a hedge fund, and they want to do it consistently. Now, hedge funds run in packs because at the end of the day, if you want to sway sentiment, you do it in a group environment. So most hedge funds, what you'll see is they'll rally around a certain, either a certain market segment or a general sentiment that they're trying to push. And if you're a hedge fund that is outside of that loop, or you don't want to run with the pack, good luck trying to beat or attract new investors to your fund. It just won't happen. We've seen that time and time again. So, and now of course, where hedge funds differ from each other is how quickly they enact their new strategy and how well they hold on to that strategy. And I'll explain that in a second. So we know that hedge funds want to sway opinion. And what do we see in the market over the last 3 months? Massive, massive opinion shifts. We have a huge shift in the commodities market. What we're seeing is massive lumber prices. We see lots of fear around bond yields being driven higher, resulting in inflationary scares. We've got this constant air of fear, short supply, driving prices up, as I mentioned, commodities and so on and so forth. And a lot of the fear is coming from, is this transitory or is this a continued hyperinflation environment, which I don't think it is. I don't think lumber prices are going to double every month from here on out. I think supply chain issues, on lumber in particular, it's to do with Canada and some other bits and pieces, but I think that'll all get worked out. So certainly from my perspective, I believe it's transitory, but it plays into the hands of these hedge funds driving this bearish sentiment. So what is that sentiment? Well, we have seen a massive rotation out of high growth into value, right? So we've seen that switch happening over the last 3 months. We've seen growth out of our tech names move into value. So that's step one, right? Step 2 is hedge funds will then see tech, certainly high PE tech, which is a lot of these smaller names getting clobbered. They'll see this as an opportunity to short. And that's what's been happening. When overall market sentiment is bearish, it's very, very easy to be a bear. And being a bear means you can short the market. So you get some profitability that way. So you've rotated from growth to value, and you've gone ahead and shorted growth. So it's two big wins for the hedge funds. And then third, they still have this bug on their back here around all of this new talk that the hedge funds are dirty and the people that expose this inconsistency. We saw that in the headlines, right? So what do? Well, we shift the narrative. So we see the narrative now moving to what? To crypto. So we see crypto as almost a scapegoat to forget about the other headlines that were being generated a few months back. And this isn't super conspiratorial. It's actually very, very easy to get people to rally behind something like Doge, right? It wouldn't take much effort at all. And that's what we see happening. We see a lot of headlines now being grabbed by these crypto phenomenons. And I'll probably make another video on that because that's a very, very damaging thing for crypto overall. But we probably don't have time for it right here. This is meant to be quite short. So what we see is headline grabbing into crypto, and we're driving crypto volumes up, which means we're reducing volumes in the equity market. What happens when we reduce volumes in the equity market? Well, it becomes a lot easier to control the equity market. That's why you see some very, very interesting price movements after hours. It's because there is just super, super low volume. So we're not at those levels, of course, but a lot of volume is leaving equities, moving to crypto, and I believe that's just to A, make money. So if you're making money on crypto, excellent. But B, drive headline grabbing news as well. So the goal here for the hedge funds, in summary, is to pay back retail investors for making them look silly, recoup some of their losses, move the conversation to crypto so everyone forgets about the big hairy things being uncovered, or that were uncovered in the equities market. And I think what will end up happening, what will slowly start to transpire over the next 3 to 6 months, is crypto sentiment will change post this Doge ramp down. How long that lasts, who knows, right? Could Doge go to $1, $2, $5, $10? Sure, of course. But there will eventually be a ramp down, and the narrative will absolutely change overall when it comes to crypto. In fact, it'll probably be ridiculed. What they'll do is they'll plant a narrative that all crypto is speculative, all crypto serves no purpose, thereby the blockchain serves no purpose, which is no good. Again, story for another day. We'll see a rotation back out of value into growth when value stocks become sillily priced, let's put it that way. So let's take airlines, for example. Airlines will never go back to what they were for one primary reason. If you're in business and you used to travel for business quite frequently, you're not going to do it as frequently. And that was really the cash cow of a lot of the airline businesses. So we'll see that rotation when value just becomes overrated, and we'll see that through the next few earnings cycles, I believe. And of course, hedge funds, they're going to make a ton of money, and they're going to start playing a little bit more fairly, we hope, when these new NSCC rulings come out, end of May, early June. That's my take. Again, off the cuff, hopefully not too conspiratorial sounding. A lot of truth there. Love to dig into it further. Let me know what you think. I'd love to hear your thoughts. What am I wrong on? Does everyone believe I'm right? What do you think is going to happen over the next few months? Thank you so much for your time, and hope to chat soon.